U.S. stocks rise as investors weigh vaccine hopes. Shift from growth to value stocks, advisor. Wall Street closes higher. NASDAQ sets record as potential vaccines show promise. So we've all seen these back and forth news articles about rising cases to new vaccines finally breaking through, to Congress stalling a new stimulus bill, to primary election polls for this upcoming November election. The economy was forced to a standstill by the government, yet the stock market has been on a rapid recovery since its all-time high on February 20th, crashing down to a bottom on March 23rd. Right now, it's July 20th. S&P 500, the Dow Jones, and the NASDAQ indices are back to where they were in February, once again flirting with all-time highs on a weekly basis. The question I'll be trying to answer in today's video is why? The stock market is supposed to be a reflection of the economy in its current condition, is it not? The stock market at quick glance historically can be used to determine the economic conditions at the time, like during the 2008 financial crisis, early 2000s internet bubble, and the 1929 crash during the Great Depression. But as we can all see, that won't be the case when we look back at 2020 on a stock chart down the road. What's going on, you bears and bulls? My name is Chris Reed, and in this video I'll be explaining why I believe the stock market is on such a bullish tear despite what's going on. Before we start, quick disclaimer, this video is for entertainment purposes only. I am not a financial advisor, economist, nor do I hold a position in the finance industry. I just like the subject of money. I like to do my research, and these are my thoughts. You should do your own due diligence and contact a licensed financial advisor and not take random financial advice from YouTubers. So why is the stock market still going up? Through some research of my own, I believe it has to do with four main factors, and we're going to break them down in this video. Since everyone thinks another crash like we saw in February is looming in the near future, I opened up the stock market crash archives and discovered that most, if not all, of these factors I'm going to break down to you were present in each of the last three major economic slowdowns. The first factor we'll talk about are interest rates, or more specifically the federal funds rate. The federal funds rate is the rate of interest the Federal Reserve, or the central banking system in the United States, uses to charge big banks, aka Chase, Bank of America, Wells Fargo, to borrow money. As the Fed raises rates, it becomes more expensive to borrow for the commercial banks, so they raise their interest rates on their profitable financial instruments such as credit cards, home loans, auto, student, business loans, passing on that cost to you, the consumer, to cover their borrowing costs. The cost to borrow always cycles down to its lowest level, aka you, the consumer. On financial instruments that generate interest for you, the consumer, such as high-yielding savings accounts, bonds, and certificates of deposit, the interest rate gets lowered. Yet another way commercial banks make up for increased borrowing costs. Now that your savings accounts don't make so much, where can you generate a better return on your money? Well, the stock market has historically returned 7% adjusted for inflation over the last century. Sounds like a good parking spot for this lump sum of cash, so long as a crash doesn't happen. In 2008, and more recently in 2020, the Federal Reserve, in an effort to boost the economy, lowered the federal funds rate to record lows of 0%. That making it basically free for commercial banks to borrow money, actually making it cheaper for consumers to borrow money in any of the forms I previously mentioned. In 2020, data shows that people are borrowing money or margin investing at record low interest rates to invest in the stock market, where they can make up the difference and generate a better return on their money. In today's economy, mathematically, it makes more sense to invest your money in the stock market than to have an abundance of cash getting eaten away by inflation. The opposite was the case during those historic market crashes. During economic crises, people would liquidate their investment portfolios and retirement savings to sit on cash out of fear the market would evaporate their savings. I can pretty much guarantee that won't be the case unless the apocalypse comes, and by then, your dollars won't have much value anyway. Essentially, what a stock market crash is a massive liquidation of assets to cash, driving the share prices down in the process. If it becomes cheap to borrow money and you can cover the cost by buying appreciating stocks, that's going to drive up demand, thus boosting share prices. This theory gets a boost when everyone adopts this mentality all at the same time. This is why, in my opinion, the low interest rates and the Federal Reserve's plan to keep them low until we get out of this pandemic, as stated by the Fed's chair, Jerome Powell, is the strongest reason why I think the market keeps going up. Up next, the second factor I believe the stock market is so bullish is because of a concept known as quantitative easing. QE is economic stimulus or help from the government through different measures. Stimulus checks, relief acts, business bailouts, but most of all, this concept of money printing by the Federal Reserve. The one stimulus check we got back in April may have helped the economy slow down its decline at the time, but more recently, there's been a large support for another check to be approved from Congress. When the markets fell in 19 1929, President Roosevelt and the government introduced the New Deal in 1933, a series of spending programs with the intent to help a struggling economy. The market peaked in 1929 and fell for a number of debated reasons. With the economy and mirroring stock market free-falling, the government finally decided to intervene in 1933 when the market finally bottomed out. There was hope again. Dow Jones would, however, not return to its 1929 peak until the 1950s, almost 2 decades later. In 2008, when the housing crisis almost collapsed our entire financial system, big banks and insurance companies were some of the most negatively impacted. In response, the government came to the rescue with the Troubled Asset Relief Program, which involved the Federal Reserve lowering interest rates and printing money to buy toxic assets from these big companies. This had been referred to as the big bank bailout. The stock market bottomed out, but started to recover once this act of quantitative easing was felt throughout the nation's economy. Back in February, the economy was forced to essentially shut down by the government to prevent the spread of a virus. In response to the stalled economic conditions, the government introduced the CARES Act, which saw stimulus checks mailed to taxpayers and their families, the Federal Reserve lowering its interest rates back down to 2008 levels, and buying toxic assets again from companies severely affected by the shutdown that was mostly the travel industry. Since enacted in March, the government has worked hard to keep the economy afloat, and while things tend to be slow, heading upward, yet still not fully recovered in the real world, the stock market appears to be forward-thinking. The optimistic expectations of a full recovery are inherent in constant share price increases. Next, the third factor why I believe the stock market is so bullish is simply inflation. Inflation is the invisible phenomenon that states as more money gets printed, it circulates into the economy, businesses will increase the cost of their goods and services, thus decreasing the purchasing power of your everyday dollars. Every year, your $100 bills are able to purchase less and less because businesses simply increase the price tags, probably at a rate that you wouldn't even notice unless you paid close attention. Prices for goods and services are significantly higher today than they would be 30 or even 15 years ago. That's just the nature of this invisible thief. With that being said, on the business's balance sheets, it looks like they make more and more profit every year. If there's more money in the system, raise prices for the same products, that equals to a profit increase on paper year to year. This artificial profit increase on paper makes its way to investors who then buy into that profitable company, increasing demand for that underlying stock, driving up the share price further. Investors use assets like real estate and the stock market to generate a return on their money to outpace inflation. If investing in a broad stock market index over the last century has returned 10%, only 7% is actually received net by the investor. Inflation rises by 3% every year, eating away at those returns. For consumers with less risk tolerance, bonds, high yield savings accounts, and CDs are used more commonly. They tend to appreciate at the same rate or around the same rate as inflation with not as much risk as stocks. This old saying goes, more risk, more reward. Since stocks are more risky, the returns can be higher or lower, but there still exists that chance to outpace inflation. Mix all three of these together, interest rates, quantitative easing, and inflation, and you get my fourth factor, and that's consumer vacuum. What I mean by that is that companies with a business model built to maintain a consumer base have been the main ones still seeing their share prices increase during this time. The main ones that manage to stay relevant during the economic slowdown have been the ones with brands strong enough to provide goods and services while people are being required to stay home or social distance. People still need to do their shopping either online or in person. People are still watching their shows and movies, if not more now than ever, and getting their news, whether it's from social media apps or big news networks. My point is, the goods and services of these companies are still relevant during this time. I won't name any specifically, I'll let you guys speculate, but I'm sure you could guess who I'm referring to. Those are the companies that swing the entire market upward. Let's recap. The Federal Reserve lowering interest rates and the government using quantitative easing measures creates a bottom for the overall market. Inflation gives the share prices essentially unlimited potential to keep increasing. Your mission as an investor is just to attach your money to the stocks that also attract the most investors, no matter what the condition. I firmly believe and support in the strategy of long-term investing. I think short-term volatility in the stock market is just too unpredictable. A short-term graph of the stock market has been called a snapshot of human emotion. I believe the best strategy is to just buy and hold good companies in whatever form you like, whether that's a low-cost index fund or broad sector indexes, which allow for instant diversification without the risk of individual stock. And holding these might be a roller coaster day to day, but have proved to come out ahead over a 30 to 40 year investing horizon. That'll be it for me today. Those are my thoughts on the stock market's behavior this year. If you like this video, give it a like, consider subscribing for more random content, share it with a friend. If you haven't already opened up a Robinhood account of your own, I'll be leaving my referral link in the description below. Use it, you and I will both get a free stock courtesy of Robinhood. It's a free commission stock trading platform that makes investing as easy as opening up your phone with just a few clicks. This video isn't sponsored, I'm just an advocate of getting started with investing, and Robinhood makes it so super simple. You guys stay safe out there, stay hungry, and I'll see you on the next one, and I'm out.